The IRS is giving away free money, but most people don't know how to claim it. The choice between a Roth and traditional retirement account could be the difference between hundreds of thousands of dollars in your pocket or the government's. This is the retirement decision that matters most. When it comes to saving for retirement, most people focus on how much to save. But there's a more important question that most people never ask. Which type of account should you use? Let's break down the fundamental difference between Roth and traditional retirement accounts, and more importantly, how to figure out which one is right for you. The basic difference. The difference between a Roth and traditional account comes down to one thing: when you pay taxes. With a traditional account like a traditional IRA or a 401k, you get a tax break now. The money you contribute reduces your taxable income this year. You won't pay taxes until you withdraw the money in retirement. With a Roth account, you pay taxes now. You contribute money after taxes, so there's no immediate deduction. But when you withdraw in retirement, the money comes out completely tax-free. Here's a simple example to illustrate the point. Say you're in the 24% tax bracket and you want to contribute $10,000 to your retirement. With a traditional 401k, $10,000 costs you only $7,600 after the tax savings. With a Roth, $10,000 costs you the full $10,000 because you've already paid taxes on it. But here's where it gets interesting. When you retire and withdraw that money, the traditional withdrawals are taxed as ordinary income. The Roth withdrawals? Completely tax-free. So which one wins? It depends entirely on your tax situation now versus your tax situation in retirement. When a traditional makes more sense. There are two main scenarios where a traditional account typically wins. First, if you're in a high tax bracket now but expect to be in a lower bracket in retirement, the traditional gives you the bigger benefit. You get the tax break at 24% now and pay taxes at maybe 12 or 15% later. Second, if your employer offers a match on your 401k contributions, you should almost always contribute enough to get the full match, regardless of which account type you choose. That's free money, and it doesn't matter whether it's in a Roth or traditional. Here's the math on the employer match. If your employer matches 50% of your contributions up to 6% of your salary, and you make $100,000 per year, that's $3,000 in free money. Whether you put that in a Roth or traditional, it's still $3,000 you wouldn't have otherwise. When a Roth makes more sense. A Roth typically wins in three situations. First, if you're in a lower tax bracket now than you expect to be in retirement. This is increasingly common for people who have fixed incomes in retirement, but had higher incomes during their working years due to promotions and raises. Let me give you a real example. Suppose someone earns $150,000 per year during their career. They're in the 24% bracket. But in retirement, they only have Social Security and a small pension totaling $40,000 per year. That puts them in the 12% bracket. In this case, paying taxes at 24% now and getting tax-free withdrawals at 12% later is the winning strategy. Second, if you're young and just starting your career, a Roth is usually the better choice. Your tax rate is likely lower now, and your money has decades to grow completely tax-free. The power of tax-free growth over 30 or 40 years is enormous. Here's what I mean. If you contribute $5,000 per year from age 25 to age 65, that's $200,000 in contributions. But at an 8% annual return, your Roth could be worth over $1 million by age 65. Every single dollar of that growth comes out completely tax-free. Third, if you expect to have other sources of retirement income that will push you into a higher tax bracket, Social Security, pension income, and required minimum distributions from traditional accounts can all combine to create a surprisingly high taxable income in retirement. The backdoor Roth strategy. Here's something that most financial advisors won't tell you. Even if you make too much money to contribute directly to a Roth, you can still get money into one through a strategy called a backdoor Roth. Here's how it works. You contribute to a traditional IRA, don't take the deduction for the contribution, and then immediately convert it to a Roth. The IRS doesn't know the difference between a conversion and a regular contribution, and you get all the benefits of a Roth regardless of your income. This strategy has become more popular in recent years, and while there are some rules to follow, it's completely legal and available to anyone. There are income limits on direct Roth contributions, but no income limits on conversions. The key is that you can't have other pre-tax IRA money when you do the conversion, or the IRS will tax it all proportionally. This is called the pro rata rule, and it's the main complication with backdoor Roth strategies. The most important thing. Regardless of which account type you choose, the most important thing is to actually save. The best account in the world is worthless if you don't put money into it. Start somewhere, start now, and adjust as you learn more about your specific situation. I see people all the time who spend months or years analyzing the perfect strategy while their money sits in a savings account, earning almost nothing. The perfect is the enemy of the good. Just starting to save, even in the wrong account, beats not saving at all. The biggest lesson here is that tax planning is personal. What works for your neighbor might not work for you. Your income, your expected retirement income, your employer's matching, and your time horizon all factor into the decision. Don't overthink it to the point of inaction, but do take some time to understand the basic difference. A few minutes of planning now could mean hundreds of thousands of dollars over your lifetime. The Roth versus traditional decision is one of the most important financial decisions you'll make. Take it seriously, do the math, and pick the strategy that works best for your specific situation. If this was helpful, hit that like button and drop a comment below. What's your biggest retirement planning question? I'd love to hear what's on your mind. And if you want more content like this, subscribe. I share exactly what I wish I knew so you can make smarter money moves.